Every dollar you have ever held was once a paper promise to hand you a fixed weight of gold on demand. That promise is gone. It did not fail slowly, and it did not fail by accident. One evening, the most powerful government on earth simply stopped honoring it, called the change temporary, and never brought it back. I am telling you that up front because it is the whole key to the number that brought you here. The reason a figure like $8,000 for a single ounce of gold is not a fantasy is that gold does not climb in a straight, polite line. It sits still for years while a monetary system pretends nothing is wrong, and then a wall gives way. And gold does not rise 10 or 20%. It reprices into an entirely new range and never fully comes back down. That is the honest answer to the title. The number is not a promise, and I will show you the risks before I am done. But it is a real case, built on something that has already happened. And once you see the machinery, you will understand why the smart money is not waiting for permission. Here is the concrete thing to chew on before we go anywhere. In my years in the gold and silver world, the single most important fact I have learned is that gold is not really priced against dollars. It is priced against confidence in the system that issues the dollars. When that confidence holds, gold looks boring and useless, and everyone on the financial channels tells you it pays no interest. When that confidence cracks, gold becomes the only asset with no counterparty, no promise attached, nothing anyone can freeze or default on. And confidence, once it breaks, does not repair itself at the old price. Let me take you back to the arrangement that governs everything you are watching. After the Second World War, the world sat down and built a monetary order on purpose. Every major currency was tied to the American dollar at a fixed rate, and the dollar itself was tied to gold at a set price. It was, in effect, a single global wall. Behind that wall, gold had a value carved in stone, and it did not move because it was not allowed to move. For a generation, that was simply reality. But a fixed price is only real if the people running it can defend it, and underneath the calm surface, foreign governments were quietly doing arithmetic. They looked at how many dollars America was printing to pay for its wars and its spending, and they looked at how much gold actually sat in the vaults behind those dollars, and they realized the two numbers no longer matched. There were far more paper claims to gold than there was gold. So they started showing up at the window, politely, asking to trade their paper back for metal, exactly as the deal promised. Before the whole thing collapsed, a group of leading nations pooled their reserves and spent them by the ton trying to hold the price of gold at its official level. They sold real metal into the market day after day to keep the number from moving. Think about what that tells you. Keeping gold artificially cheap required draining the actual vaults of the most powerful economies on Earth. It could not last, and it did not. The pool broke, the window closed, the wall came down. And here is what every retiree needs to burn into memory, because this is the pattern that pays the whole video off. When that wall fell, gold did not drift up by some sensible percentage. It went from around $35 an ounce to, within a single decade, more than $800. That is not a rally. That is a repricing of more than 20 times over. The metal did not change. The gold in the ground was the same gold. What changed was that the system holding its price down let go, and the price snapped to a level the old managers would have called impossible. So let me do the arithmetic the title is really asking about, plainly and honestly. If gold is trading near $4,000 and a broken monetary wall once multiplied its price more than 20-fold in 10 years, then $8,000 is not a moonshot. 8,000 is a double. A double is a fraction of what already happened once inside living memory. I am not telling you it must happen, and I will get to what could stand in the way. But when someone laughs at 8,000 gold, ask them why a mere doubling sounds crazy from an asset that has already gone up more than 20-fold when a monetary anchor broke. The precedent is not a theory, it is on the record. Now, I want you to picture one real person caught in these turns, because a number on a slide never moves anyone. Picture a tool and die maker, a man who spent 40 years making precise parts on a shop floor, who did everything a careful man is supposed to do. He saved, he trusted the currency his paycheck came in. He believed the people in charge would protect the value of what he set aside. And he watched, across his working life, the buying power of those savings quietly bled away every time a wall broke and the money was rebuilt on looser terms. He was not reckless. He was loyal to a promise that the people who made it had already stopped keeping. That is the man this video is for, and if any part of that feels like you, stay with me. Because the reason I am confident the pattern is live again is that we are watching a monetary system get rewritten in real time, quietly, right now. And the people rewriting it are not internet forums or newsletter writers. They are central banks. The most conservative, slow-moving institutions on the planet have been buying physical gold at a pace we have not seen in generations. Well over 1,000 tons a year for 3 straight years, roughly double what they were buying the decade before. That buying has cooled a little from its peak, but it remains far above the old normal, and survey after survey says the great majority of them intend to keep adding. Stop and really hear that, because this is the strongest signal in the entire market. These buyers are purchasing gold at or near record high prices. They are not bargain hunting. They are not trading for a quick profit. They are moving reserves out of paper promises and into a metal that no other government can freeze, sanction, or inflate away. And that motive got sharper the day the world watched one major power have its currency reserves frozen with the stroke of a pen. Every finance minister on earth absorbed the same lesson in an instant. Paper reserves held in someone else's system are only yours until that someone decides they are not. Gold sitting in your own vault has no such condition attached to it. Let me put a marker on how far this has already gone, because it is the kind of thing the financial media strangely underplays. Gold has now quietly overtaken the euro to become the second most held reserve asset by central banks on Earth, behind only the dollar itself. That is not a forecast. That is where we already are. The wall of the old system is not theoretical anymore. The people who manage nations are voting with their vaults, and they are voting against paper. And that brings me to why I am talking to you specifically, because this is exactly the moment where a regular American with a lifetime of savings has to make a decision the professionals already made. If you have $100,000 or more in a retirement account, a 401k, or an IRA, I want you to have the same tool the big institutions use to think this through. My family has put together a free guide, the Retirement Wealth Protection Guide, and it walks through how everyday retirees can diversify a portion of what they have built into physical gold and silver inside the retirement account they already own, without taxes and without penalties, using what is called a self-directed precious metals IRA. This is not just for insiders, and it is not just for the wealthy. If you have $100,000 or more in any retirement account, this is for you. If you're watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours. No obligation and nothing to buy. Now, let me keep my promise and give you the honest caution, because a man who only tells you the upside is a man you should not trust. Gold does not go up in a straight line, and the very repricings I am describing are violent in both directions. In that great decade-long run I told you about, gold did not only soar. Midway through, it lost nearly half its value first, cutting savers in two before it went on to its highs. I have watched more recent shakeouts do the same thing. When a hint arrived that the central bank might slow its money printing, gold fell by roughly a quarter in a matter of months, and nothing about the long-term story had actually changed. So understand clearly what I am and am not saying. I cannot tell you the day. I cannot promise you the price. I will not insult you by pretending I know the timing of something no one can time. What I can show you is a mechanism and a precedent, and let you decide. Here is the part that actually changes things, and almost nobody on the financial channels will connect these two dots for you. For decades, there was a rule that gold obeyed like clockwork. When real interest rates went up, gold went down, because who wants an asset that pays no interest when safe paper suddenly pays you plenty? That rule was iron. And recently, it simply broke. Gold has been climbing even as real yields stayed high, doing the opposite of what the textbook says it should. When an old, reliable rule stops working, it is almost never random. It means a bigger force has entered the room, and the bigger force is the same one from the anchor of this whole story. Confidence in the paper system is quietly failing, and gold is responding to that, not to the interest rate. And notice who is nervous about you understanding this. The big banks and the trading desks make their living on churn and on paper. Far more paper claims to gold trade every day than there is metal to deliver against them. That works beautifully as long as almost no one asks for the real thing. It is the same setup that broke the old fixed system when foreign governments finally lined up at the window and demanded metal for their paper. The people running the paper machine do not want a room full of savers deciding they would rather hold the actual ounce than the promise of one. That is the real reason gold gets waved off as a barbarous relic that pays no interest. A calm and confident public holding physical metal is the one thing that system cannot easily survive. Here is a detail worth putting on the wall because it proves the point better than any forecast. After that old fixed price finally broke, gold never once returned to it. Not in a bad year, not in the deepest slump, not ever. $35 an ounce, the price defended by pooled national reserves for a generation, simply ceased to exist as a ceiling and became ancient history. That is the signature of a broken wall. The price does not swing back to the old range once the crowd calms down. The old range is gone because the thing that held it there is gone. Every wall that has fallen has done the same, and each one has left gold living in a whole new territory it never left again. That is the reason a repricing is not the same as a rally, and it is why protecting a portion now is a fundamentally different decision than trying to trade a wiggle on a chart. And understand the plumbing underneath, because this is where the next wall is most likely to give way. On the exchanges where gold and silver are priced, there are many times more paper claims to metal than there is metal actually sitting in the vaults available to deliver. The registered inventory that can be delivered against those claims has been drawn down. Meanwhile, physical demand from the East has been so heavy that at moments of stress, buyers there have paid a premium over the price set in London to get their hands on the real thing. So you have a paper price set in one place and a physical scramble happening in another, and those two cannot stay disconnected forever. A wall does not need a headline to break. It only needs enough people, quietly and at once, to decide they would rather hold the ounce than the promise of the ounce. That is what emptied the vaults in the old system, and the structure that lets it happen again is sitting in plain sight. Let me widen the lens, because this repricing pattern is not a one-time historical curiosity. It is what the government does when it needs to. Long before that post-war wall fell, an American president revalued the dollar against gold by decree in a single stroke, raising the official gold price by nearly 70% overnight. Savers did not get a vote. The metal did not move. The dollar was simply redefined to be worth less gold, and anyone holding gold woke up richer in dollar terms, while everyone holding only cash woke up quietly poorer. That is the tool in the drawer. When the debts of a nation grow too large to ever be honestly repaid, history shows the escape hatch is not default. It is to shrink the value of the money the debts are owed in, and gold is the scoreboard that measures exactly how much shrinking has occurred. And we are living inside the conditions that make that hatch tempting. There is a name for what happens when a government's debts grow so heavy that the central bank can no longer set policy freely, because the priority quietly becomes keeping the government's borrowing costs manageable rather than protecting the currency. We have been down this road before in our own history, when the central bank pinned interest rates low for years to help finance the national debt, and the saver paid the bill through lost purchasing power without ever being asked. When a central bank is caught between fighting inflation and protecting an indebted government, the saver holding paper is usually the one who absorbs the loss. That is not a conspiracy. It is arithmetic. Now here is where you have to think honestly about your own position, and this is worth more to you than any target number. First, own the real thing, not a paper claim to it, because the entire lesson of every broken wall is that paper promises are honored right up until the moment they are not. Second, size it so that a shakeout can never force you to sell. Remember, gold cuts savers in half in the middle of its greatest run. If you are so exposed that a temporary drop forces your hand, you will get shaken out at the bottom, which is exactly the outcome the trading desks are counting on. And third, never, ever sell into the panic. The metal that gets dumped in the fear is the metal the patient buyer is quietly collecting. Protection is a portion, held with steady hands, not a bet you cannot sleep through. I want to be straight with you about where we are in the cycle, because this is the recognition that matters most. The institutions that move nations have already made their move. They are buying at record prices, they have pushed gold past the euro in their reserves, and they are doing it precisely because they can see the old system being rewritten from the inside. The pension funds, the mainstream advisors, the financial press, the ordinary saver at his kitchen table have not caught up. The story has not gone fully mainstream yet. And by the time it does, by the time gold leads every news segment and every advisor on television is finally recommending it, the repricing this video is about will largely be behind us. You are not late. You are, if anything, standing where the quiet professionals stood before the crowd arrived. The whole point is to understand the wall before it breaks, not after everyone can see the rubble. So let me answer the title one last time, cleanly, with everything we have walked through behind it. Does $8,000 gold require a miracle? No. It requires a wall to break, and the walls are already cracking. It requires a monetary system to be rewritten, and central banks are rewriting it in front of us. It requires the price to double, when the last broken anchor multiplied it more than 20-fold. I cannot promise you the number, and I cannot give you the day, and anyone who does is lying to you. But the case is real. It is built on things that have already happened, and the arithmetic is not the hard part. The hard part is acting while it still feels early. Which brings me back to that tool and die maker, and to you. He was not a fool. He was a careful, loyal man who trusted a promise that the people in charge had already stopped keeping. You do not have to be that man. You have the one thing he did not, which is a clear view of the pattern before the wall gives way. So if you have $100,000 or more in a retirement account, this is your moment to protect and diversify a portion of what you have built, and to protect what your children and your grandchildren will one day inherit. Because a legacy is not just what you leave, it is what still holds its value when it arrives in their hands. Get the free Retirement Wealth Protection Guide. And for those of you who have watched to the very end and mentioned that you did, my family is offering a free one-on-one educational web conference for viewers with $100,000 or more to walk through your own situation with no pressure and no obligation. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. There is no fake deadline here. The honest reason to look now is simply this. The moment a decision like this is still cheap, still calm, and still fully your own to make is the moment before the wall breaks, not the morning after. From our family to yours. Go take care of it.